Go. Okay, good. Even recording is on now. So, guys, thanks so much for joining me for this special webinar about why crude oil prices turn, or why crude oil effectively turn worthless, and what could lay ahead for investors. So, we're going to talk a bit about what happened, look at some indicators, try to understand, and then try to describe to you what you should be looking at, and how we can potentially use that information to hopefully make better investments in crude oil, may it be crude oil directly, or also maybe investing in crude oil stocks as well. And if you guys are new to me, a little introduction. My name is Alejandro Zambrano. You can call me Alex. And you can find me on Twitter at AlexFX00. And I'm actually the Chief Market Strategist at ATFX. I'm also the Chief Editor and creator of the website called investingcube.com, which is where you find my daily market update that I produce every day. It also goes out via the ATFX YouTube channel. And I also write content primarily on that site, and I manage the team. So, what are we going to be covering today then? Again, crude oil, but because we're dealing with sort of financial markets and investing, we need to start out by showing you the risk disclaimer a bit before we start. So 67.67% of retail investor accounts that trade with ATFX lose money. It's really important you understand that. It's a little bit like what you will see on the back of a cigarette pack, and that is effectively smoking can kill, can give you cancer. This is not going to kill you, but you can easily lose your money, and 67.67% of the people lose their money. And the number one reason I think for that is because people just trade with too much leverage, which means that they take on huge position, and they can't tolerate normal volatility. But with the help of getting yourself educated, understanding market risks, understanding the market itself, it's possible to put yourself where you do not belong to those 67.67% of people that lose money. Instead, you belong to the group that make money. And that is exactly why we're here. So we can avoid having you guys in that group. By the way, guys, I've been trading since 2006 and I still have losing years. So even if you have experience, that doesn't necessarily ensure that all years are going to be positive. But if you do have experience, you put yourself in a position where you can potentially hopefully make more money. Now, I'm going to share a bunch of information with you, which I think are from reliable sources. I'm also going to share with you guys my opinion on the market, but this doesn't mean necessarily that it's going to play out. Why? Well, because only God effectively knows what's going to happen next. And the problem with financial markets investing or trading is that the markets are made up by humans, people like you, people like myself, and we all interpreted the market and the market data in different ways. We have our own views, we have our own problems. We all apply that when we're reading into things. And at certain points, you are gonna find a setup and people will agree with you. So, and you just happen to buy like the minute before everybody else bought, or the day before, or the week before, and then everybody agrees with you. And that is when you make money. However, if the market is not agreeing with you, and as you know, people can be irrational, especially when it comes down to money, then even though you have a textbook example of something that should happen, you might still not make any money on that. You may in fact lose money. And that is because we humans are inherently not rational. Well, it's difficult really. And we're not really, we are rational, but we're not rational always in the short term when it comes down to financial markets. So it's really important you understand that. Okay, let's continue. So why should you spend the next half an hour with me? Maybe a bit more as well if you have questions. Well, I have quite a wealth of experience. I have been trading since 2006. So I learned a ton. I tried many different systems, traded short-term Forex, short-term stocks, indices, commodities, and even cryptos I traded. I traded a bunch of stuff. And I learned, and you learn a lot by trading with a real account. So hopefully I can transfer some of my skills to you. And because of my skills, I was tasked to create investingcube.com. I'm also ATFX Global Chief Market Strategist. ATFX is a superb FCA regulated company, and it's not the first one I worked for. I worked for Amana Capital as their Chief Market Strategist. Amana Capital, you might not know them because they're not really big in Europe. They're in fact probably number 2 and number 3 biggest retail broker in the Middle East. And before that, I used to work for FXCM and Daily FX, which you probably know of. FXCM used to be the world's biggest retail Forex broker for many years, had a huge amount of clients and across the whole globe. And I was there managing the team of the London research desk. Some of the guys I work with are now working for other brokers as analysts as well. But I think the key point here is that I started in 2006 trading. I love the markets. I have a lot of passion for the markets. And in the very beginning, like not every minute, but every weekend or so was spent reading up on the markets. I did also study finance and economics at university, so I know the macroeconomics, the microeconomics. I know finance. I know all this stuff that completes my education when it comes down to trading the markets. Okay, good. So let's continue here. So what are we going to talk about over the next half an hour? I'm going to talk a bit of what caused the oil price crash, could have been predicted, how storage facilities affected the price, and what happens when an asset goes negatively, and what can we expect going forward. So let's talk about the first few things then, just lay out some groundwork as well. So what actually happened here and when did it happen? So first things first, crude oil effectively turned worthless on Monday, April 20th, and it happened at 2:30 p.m. Eastern time. So 2:30 p.m. New York time, more or less. At that point, crude oil, which you usually have to pay for, was trading at a negative level of the lowest level was $40.32 per barrel. So normally you have to pay for something like crude oil, but here you had to pay someone to buy it from you. Think about that. So that is how extreme it went. And there is a particular contract that went negative, and it's what we call West Texas Intermediate. And that one is traded on the New York Mercantile Exchange. There is the other one, the big cousin, which is Brent crude oil. And Brent crude oil did not go negative. Brent crude oil is based on production in the North Sea here in Europe, and that is the benchmark for the crude oil from Saudi Arabia and places like Russia. And Saudi Arabia produces pretty much as much crude oil as the US does. So West Texas is not a small contract, it's actually a huge contract, and it is really important. But because the way system has set up, at least up until recently, it's been difficult for the US to even export crude oil because they have all these different regulations in place. The price of crude oil in the US has been following Brent crude, but it doesn't always follow Brent crude because it's affected by its own dynamics. So this is just a chart, and you can see here that on April 19th, the price was at $18.99, and then this whole market just collapsed and went to a negative outcome of $40.39 per barrel. The actual amount of contracts traded was about 250,000, and every contract is worth, if I remember correctly now, 1,000 barrels. So every contract is worth 1,000 barrels. You can see that this is the volume. In fact, most of the other volume had been here, where you typically would have seen a contract of 1 million per day. So why did we have this collapse? Why? Well, if you're trading this market, if you're trading it via your CFD broker like ATFX or any of the other big CFD brokers, or even if you're trading it via one of the ETFs that are available or any other financial product, What happens is that if you hold on to that contract and you hold on to that through expiry time, you need to make or take physical delivery of crude oil, and it can't just be in your backyard. It has to be in Cushing, Oklahoma, which is a city where they have a huge network of pipelines and crude oil farms. So that's where that needs to happen. The contract says it has to happen here. You can't take delivery or make delivery anywhere else. And what's quite interesting is that typically only 1% of the futures contract go for physical delivery here, which means that 99% of the volume is just pure speculation. So it's only financial people like ourselves that are trying to trade the markets here that actually get impacted, that were impacted. The actual physical crude oil, there's, as far as I understand it, there's no signs that some producer somewhere had to sell their crude oil at negative levels. I didn't see that. So it's actually just a financial phenomenon. It's just us speculators that got hurt a lot. So long story short, if you hold a contract by expiry, you need to make or a delivery or take a delivery. So for example, if you sold the contract, then you need to deliver the crude oil. If you bought a contract, then you just have to buy the contract. But you need to buy it. So for example, if you bought one contract for 1,000 barrels, you need to take that. The problem is this though, that because everybody's doing, only us financial players and so on, we don't necessarily have access to storage. And that is the problem. There was not enough storage at Cushing, Oklahoma, even though, as you will see, there is some storage, but it was leased or otherwise committed somewhere else. So you could not take advantage of that facility. You, in fact, have to get rid of your contract. And that is why this happened. And typically, if you're trading with a CFD broker, they will switch to the new contract ahead of this. So they will close you out, and then you need to trade the new contract, or they will close you out the day before. So it's impossible that your CFCA regulated broker gets the actual contract, and suddenly you have one of the big guys, holding thousands of barrels out in Cushing, Oklahoma. So let's talk a little bit about the working storage capacity in Cushing, Oklahoma. This is a chart from the U.S. Energy Information Administration. And according to them, there's about 76 million barrels of working storage capacity. So that is the capacity over there. And in April 17th, which is just a week before the actual collapse on the 20th, there were 60 million barrels. So in fact, we were not at the 76. We're not even at the upper limit of what has been typical. You can see this is the previous 5 years range and average. The dotted line is the average, the typical, and then you have the maximum of the last 5 years and the minimum of the last 5 years. That's the range. So you can see that we're not even close to the upper range, but because there was so much financial speculation, we had that massive move. And it appears that, you need to make commitments before time. And I think some people, for some reason, did not anticipate the slide to happen. They anticipated to be able to get out safely, and they anticipated not to be able to do this. So what the EIA thinks, they reckon that the excess storage share was already leased or committed, and whoever held that were not ready to offer that to anybody else. So we're in fact not close to the working storage capacity. We're not close to the maximum, but still we got that huge move in the market. And the people are speculating to why it is. But let me give you an example. There is ETF, that's an exchange traded fund that you can access. You can probably access it via your SIP provider if you're in the UK, or your ISA provider. And you can access that fund in many different places. And they will go and they will buy the physical, or they will buy these futures contracts, which allows you to speculate like everybody else. And they received huge inflows. I think it was like 1.5 billion or so of inflows. So you had all these retail traders wanting to have a piece of gold crude because they thought it was going to go upwards, and it might go upwards. However, because these contracts expire every month, um, I think they were effectively forced to close out. So why and how did we end up in this? Well, you can see here how the number of crude oil inventory was around 14 million barrels. And then from 14 million barrels, from mid-March, we went straight up, ended up at around 60 million. Well, what changed here? Well, that was the lockdown of the US, right? I think it was on March 19 and March 22nd when you had the lockdown first of California and then New York. So you had this complete shutdown of the US, and that just caused this to bubble up and is looking to sort of burst. Maybe the numbers are going to be higher this next few weeks, but that caused that massive move. And just to give you an idea, the demand, so the EIA estimated demand in the US, and they estimate that the demand is 31% lower than the average from January through March 13th of this year. So from that point, demand dropped with 31%. And that's why we are where we are. And I reckon that until they open up, so until they ease the lockdowns, we would have a further buildup in this, but then eventually it will turn around, and that's as well what the professional thinks. It's also an issue here where you have an industry in the US which is now being haunted by its own success. So this is data from 1950 up until last year, up to until the end of 2019, where you can see how production and consumption rose in tandem, and then you had a consumption which was much higher, and this put a strong pressure on the American dollar, but production catched up. And I'm going to show you a few more charts how production has catch up. And the reason for this is, of course, the fracking revolution, shale crude oil production, where you can suddenly find crude oil and extract it from places where before it wasn't economically feasible. So effectively, they're producing more than what they actually need. And as far as I can remember, they're still under restrictions where they can't just export their crude oil the way they want. I think it was about last year, there was talks, it was in Mexico as well, they produce oil, where they did like a crude oil exchange program. So crude oil from Mexico was being sent to US, to US refineries, because they had the capacity to deal with that crude oil, and the better quality crude oil, which was available in the US, was being sent down to Mexico. Those are the sort of deals that have been happening up until the last year or so. So we know now what happened, right? The coronavirus kicked demand down with about 31%. Storage increased massively. Inventories went from about 40 million barrels to 35 million barrels, up to 60 million barrels in just a matter of just a few weeks. And of course, if this momentum continues, we'll hit that high very, very soon. And that is what caused the price to collapse the way it did. So let's go back even a bit further then to try to understand this even more. Like what happened from the very, very beginning. I don't show you here on the chart, but in January, from when things started to go crazy in China and lockdowns kicked in China, crude oil prices declined with about 22%. So we went down to pretty much these levels, just above $40 a barrel. Then there was supposed to be a crude oil deal in something called OPEC Plus. OPEC Plus is OPEC plus Russia. Now they failed, and I'll explain to you why they failed that deal. And that caused the price to slide by 58%. And we went down here. Eventually, given the collapse of 58% of the price, they actually agreed to a new deal, and that happened around April 12th. But that deal was not enough for the markets, and we had that little slide for a few days, and then we had that situation where suddenly everybody rushed to the exit and everybody wanted to close out their position. And that's when we had that 325% decline in crude oil prices, where you went of owning something that had value until you had to pay. Not only did it go down to zero, which is here, you effectively had to pay someone to take it from you. So why did that price war start? Well, first thing, it started with the coronavirus issue. And then Saudi Arabia said, guys, we need to cut production because demand is down. And now we know for a fact that demand is down with 30% in the US. And Russia said, yeah, okay, we'll cut, but it's only going to benefit the United States. And because the United States does not belong to OPEC and it doesn't belong to what we call OPEC plus. So why did Russia say this then? Well, here's some data. Unfortunately, it only goes to 2016, but it's data which shows you, I can't really see here, but it's from pretty much 1975 up until 1973 up to 2016. So you can see here how Saudi Arabia has always been a big player, producing about 9 billion barrels per day, and then we have a situation here where crude oil production declined. Sorry about that. Because of the coronavirus, the nurseries are closed, as you probably know. I don't know if you heard him, but he was in the room. It's my little one. Long story short, crude oil production in the US bottomed out here in around 2006 or so. Fracking and so on takes over, and suddenly they become a major player. And there's, if you look at a chart now, you'll see they produce pretty much the same as Saudi Arabia. So they're up there. They're up there with the big guys now, as they used to be. But because of fracking now, they're definitely back up again. Russia as well. You had. After the collapse of Soviet and so on, you had very low production and so on, and then things picked up, right? So these two guys are saying here, and the Russians were saying, look, we're not going to be able to, there's no point of us reducing production. The Americans are just going to come there and whatever we drop production with, they're going to come and compensate. So what happened was actually an all-out war, price war. So Saudi Arabia, they said, we're going to offer to our clients a discount from $6 to $8 per barrel. Now they use the Brent crude oil benchmark. So let me give you a simple example. That Brent crude oil contract, imagine it's trading at 20. Then Saudi Arabia says, okay, I'm going to give you the prevailing market price, which is 20, and then you can reduce that by 6. So you pay 14. You pay me 14 per barrel. And for some people, they said, we give you an $8 discount. So you pay $12 per barrel. That is something that high producing countries like Russia can't deal with. And it's definitely something that the United States can deal with. Because suddenly it becomes way too expensive to produce oil because you need to have all the staff, all the equipment, and so on and so on. However, though, that caused a massive tumble in the price, as you can see here. So it went down with 58%. And you can see that the war started in March, and then a month and 2 weeks later, OPEC plus, and even the Americans, I think, got involved. And actually, the Americans did not get involved, but the Russians get involved, and they go in here and they come up with a deal. And you do see some run up ahead of the deal. You see a bit of a run up. And the deal, as far as I can remember, was pretty much concluded here just before April 12th. But sort of the official thing came out on April 12th, which was a Sunday. So the question is, why did that fail? Well, the primary reason is that the number of the cuts were actually not far deep enough. So from May, we haven't even started May yet, OPEC Plus It's going to reduce crude oil production by 9.7 million barrels. And that is 10% of the demand prior to the coronavirus crisis. But from July, so just 2 months later, they're going to increase production again. So the cut is not going to be 9.7, it's going to be 7.7 million barrels per day. And from January 2021, the cut is just going to be 5.8. But around the same time, the International Energy Agency, which is different to the U.S. Energy Information Administration, they came out and said that even if the lockdowns and travel bans were lifted, demand for crude oil will still be down by 9.3 million barrels per day. So what is happening here is that, and this will be for the whole year. So what happens here is that the cut will just balance the demand. But in places like the US, it looks like the drop in demand was even stronger. It was 30%. So unless OPEC Plus goes out now and starts to push for more cuts and the Americans as well get involved, it's likely that crude oil is going to remain under pressure for longer. What's also going to happen here is that storage facilities will probably creep up more, so capacity is going to increase more. What's going to change this then? Well, you need to have that lockdowns in the US, they need to end. So ideally, one would buy crude oil. Ideally, one would have actually have bought crude oil in May. And ideally, you could have taken that oil and you could have stored it somewhere. And that's how you can make the money. But the problem for us normal people is that unless you have the ability to store crude oil, and you're not allowed to store crude oil in the backyard because of all the safety issues, it's almost impossible for us to make money here. Unless, of course, you would look to invest in maybe the share price of an oil company. That could be something, because the share price of an oil company that's well capitalized, they might be able to survive this. And that share, you buy it at the lows, hopefully, and that share can still lose 50%. You can lose everything, but it's not a forced, it doesn't have an expiry. The only time it's going to expire is if the company goes bankrupt. So going directly and buying crude oil right now for us retail investors is not as easy. There are some changes happening though. So there is something called the Baker Hughes crude oil rigs. That's something you can watch. This is published every Friday, and it shows you how many rigs are active in the US. And you can see here that leading up to March, the active number of rigs were 683 rigs. And you can see that by here, around the collapse of crude oil, the number of rigs had declined with 378. The problem though is that the rig count follows crude oil prices with a lag. So you can't necessarily use the crude oil rigs number to get an idea what's going to happen in the future. Because if crude oil prices go down with another 25% now, then the number of rigs is going to fall further. 2-3 weeks after, prices bounce back up again, and you're going to see crude oil rigs going up again. Let's have a better perspective here. So this is the numbers. This is from 1996. You can see how oil rigs were pretty much heading sideways, and then suddenly we went from maybe 400 rigs, 300 rigs to 1,500 rigs. And then the last time we had that massive collapse in crude oil, the rigs went from 1,500 to very low levels. I think up down to 400 or so, and then from 400 it went back up to maybe 800. Now we're going down. So I think this can continue to go a little bit lower, and I reckon we can probably continue to trade a little bit lower here. If we use stock markets, so let me show you something. If we use stock markets, as an indication of what's going to happen next, then I do think we could probably have crude oil prices trade higher. So if I add, for example, something like the S&P 500, you would normally, you can see that these markets are highly correlated. So you can see here that, let me see here if I did this correctly. You can see here, this is in 2015. The blue one is the stock market. So the stock market is trading sideways, and then they started to move upwards, started trending strongly because they indicated better times ahead. And what happened here eventually is the stock market, crude oil prices to go higher, and then they declined together, and then they rose together because the demand for crude oil is a proxy of the demand in the economy. And you can see here how stock markets have declined massively. And you can see here how there's a big discrepancy between crude oil prices and the stock markets. And the reason here, again, is because localized issues. It has to do with the fact that there's too much production and there's just too low demand right now. When they open things up, I think we're going to go back to normal, and I think we can have a stabilization. And ideally, again, we would have bought here, but we can't store crude oil. And because we can't store crude oil, this and the storage capacity is so full, there's always a risk that we can have an issue here, where we can have a situation like we just had. Now, because people think, let me show you this. Because people think that the situation will improve, it is possible to buy futures prices in like that are longer dated. So we have this one, which everybody's trading now, and that expires in 1598. That is trading at 1598. But you can, for example, buy January crude oil that expires in January 2021, and this one is trading at $28.85. But that's a totally different ball game. Buying at 28.85 is very different than buying at 15. Ideally, we will buy at 15 and then we sell it at 28 in January. But because this expires and because you have the limitations, you need to take either profit or a loss depending on where you entered every month here by rolling over the contracts. And that's what the professionals do as well. The producers, though, and people with access to storage, they will buy here and then they will just, they can buy at 15 right now. They can buy at 15 and then they can sell the January contract and they lock in the difference. And then when January comes, they actually make the whatever they bought at the spot market today, they give this to the buyer and they will be done with that trade at that point, and they would have netted the difference here per each barrel. Let's take a look a bit at the charts though, so because there's stuff we can do. And again, I think because of this huge gap, and I think we're gonna get some sort of a cure. I think we're gonna get even some sort of vaccine. There's about 200 projects or so in the world trying to fix this. And even if we don't get nothing now and we come back in December, well, I mean, the summer's just started, right? Well, the spring has just reached the Western world and the Northern Hemisphere. So I don't think people are going to be worried about what's happening in Christmas by now. So I think we can, and even if by Christmas capacity would have increased at hospitals and to be able to deal with the problem of the coronavirus. So I don't think it's going to be, I think, long story short, I think the situation is going to improve. So if possible, I would like to buy some crude oil, but how should we deal with that then? How should we trade it? So we need to probably just stick with our technicals for now. And my view that I share with people was actually to sell. On the May contract, I said we can probably trade lower, and that happened. Did I know that was going to go to negative? No idea about that. And even here, when that was happening, I had friends that were telling me, oh, look, I want to buy the June contract. But then on the 21st, the whole thing also declined here, the June contract. Then when we're trading down here, I said to people, okay, if we go up to 18, we can sell. The price went as high as 18.23, and I said sell here, let it come down here. The last setup was to be bearish below 19.09, and I said we can, if we really want to do something, you probably would be selling here at 15.38, between that level and that level. If one does sell on that, as with all investments, you know, the difference is 24%, but you shouldn't allow it to create a hold of 24% on your account on any given trade. If one is super confident and think we're going to go down, one can risk maybe 3% of the account. It really depends on your risk appetite. So even if the market goes up now with 24%, you'll only lose 3%. And at the same time, if it goes down, you know, you can probably make, actually, we need to put the risk reward ratio tool for that. If we would sell right now, if we go back down to the lows, if you risk 3%, then you're almost going to make 6% return. That's what we're dealing with here, because we need to adjust the risk depending on the volatility. Now, if we look at it in the longer term, I still think we're going to go up, but I think what would be very encouraging is if we have a deal between OPEC Plus and we see contractions in oil rigs in the US. I still think we're a few weeks away from a low. I think so. So I wouldn't get super excited about buying right now. But I think those things need to happen, and maybe another deal. Again, it took about 1 month for the last deal to happen. Maybe they're gonna cut production by May, and then they want to see maybe what's gonna happen. But maybe by end of May, maybe we can start seeing a bottom in the market. But what you want to look for so far is you need to pay attention to the lower and lower highs. So we are creating lower and lower highs right now, and that's all good. So the trend is bearish for now, but you want to see this stop happening. So let me see here. Let me see if I can load this thing. So what you want to see is you want to see the price go up, and then probably go down again, and then probably go up again. Or even better, what would have been even better is, for example, the price goes up and it goes down, so it creates a big range. A big range like that turns into a rectangle pattern. A rectangle pattern, we can trade. The difference between the low and the high is your target. So that would be really interesting. What would even be better is, as a minimum, you know, you have a low like that, and then maybe we'll do like this, and then we spend some time like that. So we have a small rectangle within the bigger rectangle, because then we can just go long here with a stop loss here. So from a purely technical perspective, we're not there yet. You do want to take a look at Baker Hughes, see how they collapse. If they go down to prior record lows, that could be the beginning of something. You're also looking for more signs that the US is opening, and that will probably be your key. But I think you probably need to give it a bit more time, and it might not even be interesting to trade the June contract. It might be better to trade maybe the July contract. So this is the July contract. The July contract looks a bit different, but still the same. You have a high here at 23, and then you have a low here at 17 point something. What is this? 17.13. What can you do, by the way? Because I know not all of you guys have huge experience. Well, you can go to investingcube.com. On investingcube.com, I do actually produce a daily market update where we do look at crude oil prices every day. That's me there. And you can just bookmark this page and you can join me here. You can also just subscribe to us on YouTube. That's me earlier today. If you follow us and click on that little bell button, you receive notifications every time I go live and I look at the charts. to explain to you what I think is happening. We managed the situation really good, so hopefully we can continue to manage the situation with crude oil very good going forward as well. In fact, I'm quite good at crude oil in general, actually. It's not always the best time to trade crude oil, but when there's trends and stuff like that, it's definitely interesting to check it out. As well, we're going to wrap things up now, so if you guys have any questions, you can put them in the chat box. As well, I wanted to let you know that we actually have some interesting stuff here happening at investingcube.com. So with investingcube.com, we have what we call the premium Forex trading course. It's also a general course. It's not just about Forex. It's about 4 hours long, and it looks a bit like this. Let me see if I can find it. So you can actually, if you're with the ATFX, you can actually see it in your research and education portal. So if you're already with ATFX, you can actually just log into your client portal via atfx.com, click on research education, you can see it, and you can see this is sort of the stuff. This is the way it looks like. And the same course, you can get it, and you can get it for free with an ATFX account. You can also, if you want to, you can buy it for $799. I used to sell it for $1,000. The same similar course just a few years ago. The new version though is better and improved. Or you can get it for zero cost. So you can check this out if you're interested. I'll send you the link. And also something we're doing is we actually have one-to-one coaching, and that's something we release to FX clients as well. Or you can just buy sessions for $150 per hour, and you can have these sessions with me or with any of the other analysts at ATFX, sorry, at investingcube.com. And you can with a normal account with ATFX, you get 2 sessions. There are different account types. So if you go into the higher tiers, like the Edge account, you get 2 sessions. But also for this, anything less than Edge, you get 2 sessions. But then we have what we call the premium, where you get a few more hours if you're interested to take that up. Okay, we got a question from Syed Abbas. What's your opinion when June contract will expire, will be about to expire? Can we see? Can't see the whole question. Let me see. Can we see price go negative again? Yeah, we can easily see the contract go negative again. Because I think we have a situation here where you have this big fund. It's called the United States Oil Fund. They actually released a report yesterday on their holdings, and you want to check it out. Let's do it together, actually. Okay, so 2 days ago, actually. Okay, they sell June. This is actually interesting, Reuters. There is this one, which is a huge fund. And they lost 39% of their value last week because they were selling the May contract. Three times to sort of push their contracts away. Okay, so they're actually holding 30% of July contract, and then 15% in August, September, October, December, and almost 10% will be holding the June 2021 contract. So they're holding it a bit differently than before. And what they're trying to do here is that they reckon that by July, the whole situation is going to be okay. So if they're out of the market now, out of this, then it can definitely lower the chance of having a negative prices in June. But I think the way storage is looking right now is way too early, because financial markets, they go up, like equities, they go up today because people think 1 year from now is going to be fine. the central banks are pushing money into the markets, and that's going to be fine as well. That's what people are thinking, and I think that is why we're seeing crude oil prices. Sorry, that's why we're seeing stocks going higher. And if investors get it wrongly, it doesn't really matter because they can effectively um, hold out. As long as the company does not go bust. But if you buy the S&P, it's unlikely that all companies in the S&P is going to go bust. But the problem here with crude oil prices and these futures contracts is that they have to expire. So you need to take a loss or you need to take a profit. And the way this is settled is like this. If you buy the June contract now and it expires here in June, then if you want to buy the next position, you need to buy it at 19.72. So that whatever is the difference here, you miss that out. And then if this contract expires at 1917 and you want to continue to hold your position, you will need to buy at 22.61. So effectively, you're buying in at higher levels, and it's unlikely here that you're going to be able to actually take advantage of a rise in price. And that is the biggest challenge with this market. But what you can do is that in the meantime, you don't have to be part of the whole move because that's just difficult anyway. But you can be active about it. So right now, for example, in the July contract, there's no really good technical setup here. There isn't. You need to take out this level. But for example, if you are very comfortable, you can. I don't advise a strategy because of the current situation, but for example, one could buy at close to 18 or so when stop loss is just below, and then you have a bounce of 22, and you could make like 2.98% of your money. You risk 1%, you make 3% return. But the problem is that you're buying against the overall trend, which is a big issue. So I would not be buying here. And I would probably just wait for the technicals to agree with you. Right now, even in this contract, we're dealing with a downtrend, and we might be doing that. Maybe we're here somewhere, right? So we don't really know. This could technically, if we follow the rules strictly, it's gonna go up and then it's gonna go down because in a downtrend you always create lower and lower lows. Let's take a look at BP. Now I did not double check if they are in a good state, if they have money to overcome. But this is interesting. So for BP here, they did actually bottomed out at 219 pence per contract, pence per share. So you can see how this has actually risen with 50% in BP. And here you can have some of the moves that you can have in crude oil prices. Research has shown it's better to buy crude oil, but here you don't have the same risk as long as they don't run out of money. So you want to investigate this. What's also quite interesting here is not a perfect pattern, not at all, but this is what we call an ascending triangle to some extent. If we could chop this off, it would be that. And then you have the difference here. And what it sort of suggests to you is that if it takes out that 348 pence per share price, that we can go up with some 26%. What's the other one called? Chevron? No, sorry, I'm so bad at this. I'm not a crude oil expert on shares. Let's do a little Google. Saudi Aramco, you can trade that one, but I don't think it's so easy to get hold of. ExxonMobil, I think that was what I was thinking. Let's see, ExxonMobil. Are they here? The mood is totally different. You can clearly see how this mood is totally different here. This is a market that just took out a high, and you're dealing with an uptrend, and the trend is bullish here above 38.75. This is just ahead of the coronavirus in January or so, and you have this massive. And then if you take fib from this high here to this low here, you can see we corrected to the 31.8% correction level. And I think realistically, we can probably go a bit higher from purely technical perspective. 50% up to maybe $52 a barrel would not be a crazy idea. And then here, for example, you would probably be looking to buy a dip. Let's see if we can do something like this. So if you put a pitchfork on this, it would recommend you to maybe look to buy at 42.42. Get rid of the pitchfork and simple Fibonacci. It would also suggest you around this level, so at least a correction, maybe down to these levels here could be interesting. What's quite interesting actually is this going to be an earnings report on 1st of May. So that could be maybe when you will look to maybe do something here. By the way, I'm not an advisor, and stocks is always a tricky business. You need to be licensed and stuff like that, but this is my view. And I think that you need to read up on the details, by the way, guys. If the report comes out and it's not totally horrible and we're still trading about 38.75, then we could probably go a bit higher. If we just cut straight through the whole thing here, then you wouldn't necessarily be buying it. You would actually wait a bit, let it slide, and then we'll see what happens. Okay, we don't have any more questions. I think we're going to wrap things up. If you do have questions for me, AlexFX, that's how you can get hold of me. And we do have the coaching. We do have the premium course. You can get all of that with an ATFX account, which is free. And you can trade currencies, you can trade cryptos, you can trade shares, you can trade gold, of course, you can trade crude oil and stock market indices with them. What I suggest, you can either just go to the links I sent to you on Investing Cube and sign up. If you are based in Europe, someone is going to give you a call. If you're not based in Europe, just follow the steps in the emails. And if you want me to just help you, you can always email me at alejandro.zambrano@atfx.com. You can also just ping me via AlexFX00. Okay, guys, I hope you enjoyed it. Vincenzo, thank you so much. Have a great day, great evening. Everybody else as well. Saya, thanks so much for asking your questions. And I hope to see you guys very soon for the next webinar. We do have another event on May 5th. So on May 5th, which is Tuesday next week, we have an event where we have invited 2 different speakers, and they are external speakers. And it's going to be an event from about 9 a.m. in the morning until 1 p.m. And they will effectively present some ideas, and I will also talk about it, talk about the market at that point. So it's going to be 3 different presentations. If you want to join that, ping me at Alejandro Zambrano at atfx.com and I'll send you the link. Have a good day, guys. Thank you, and bye-bye.